Gait is Group Head of Strategy at Anglo American, the British mining company listed in London, which was founded 107 years ago. A former analyst for Bernstein, Gait is one of the most respected analysts on commodities in the copper market. Gait has long argued that commodities and the improvement in mining productivity over the 20th century were key factors behind global economic development. He has also highlighted the importance of copper for the clean energy transition. Anglo American is one of the world's largest copper miners, with mines in Chile and Peru. In May, it successfully fended off a $49 billion bid from rival BHP, and it is now restructuring its business to focus more on its core metals such as copper. In this interview, Gait talks about the role of copper in the clean energy transition, why valuations of mining companies are so low compared to technology companies, and the future of mining productivity. Well, Paul, thanks so much for joining us today. You gave a fascinating presentation at the Benchmark Conference this summer in DC, and you've talked a lot about the importance of commodities for economic development and how the history of global economic development is really a history of capital accumulation, which is in fact steel and nickel and copper, which is a product of mining. So do you think mining has generally been overlooked by economists?
I think that's right. I think that that's exactly right. I mean, I think there's a very sort of strong temptation in economics to basically ignore what Austrian sort of economists would call the structure of production in favor of the sort of overall sort of aggregate. So, economists, have, obviously since the time of Keynes sort of obsessed about these sort of macroeconomic aggregates, the most important, of course, of which is sort of GDP, and tend to sort of gloss over the fact that underneath that, there's an awful lot of structure, right? And that structure matters. Whether or not one is talking about sort of service sector contributions or, contributions to economic growth arising from manufacturing and the primary extractive industries, has, a tremendous significance. And I don't think you can ignore that. And the tendency has been, of course, in the West to displace production with consumption, to displace manufacturing with services. And as long as those factors are going up, i.e. the consumption of services, we tend to believe that that is, all that's needed to increase sort of, welfare, utility, and ultimately, the goods that we are sort of trying to solve for. The fact that all of those sort of services are predicated or are dependent on this enormous accumulation of capital. And as you say, what is capital? Again, you read an economic standard textbook and you're sometimes sort of left with the sense that capital is somehow something like ectoplasm, right? This sort of vaguely amorphous stuff that kind of is fungible and sort of flows and so on and so forth. And, the reality couldn't be further from the truth. And, capital, is not this sort of dollar denominated ectoplasm. What capital really is the stock of houses, the stock of automobiles, right? The stock of, physical infrastructure that stands behind all of the services that we take for granted today. And of course, you look at what that is. Well, it's the output of, first of all, the mining industry fed through, the manufacturing capacity of the world to create these goods. And these goods, of course, finite, right? They're finite in the sense that they are depreciating. They're constantly being worn out. They're constantly needing to be replaced. And of course, this puts a constant draw on the world's sort of natural resources. So, that structure in production from the primary extractive industries through to manufacturing, through to the accumulation of the physical capital stock that we have is really vital. And that's, that's the role, of course, of the primary extractive industries. So that's energy, it's agriculture, and it's mining that is the bedrock of all that then subsequently comes, from it. And I think people sort of recognize that instinctively and they'll pay lip service to it. But then they don't actually do the hard yards and draw out the so what, the consequences of that. If that is true, right, then this sort of notion that we have that the world can sort of somehow drift into a sort of, this sort of singularity in certain sense of, in its most extreme instance of dematerialized activity, for humanity is frankly laughable, right? And particularly laughable when we sort of regard the fact that the vast majority of the population, even today, lacks the services that we take for granted in a very privileged portion, of the Western world.
I guess that perception feeds through the valuations of mining companies, right, which are quite a bit lower than those for big tech. And we've all been reading about the high valuations of big tech companies. Do you think that's changing at all, given the mineral demand needed for clean energy to meet electricity demand from AI data centers, etc. Is that changing?
That's a really interesting question. I think one of the most, and I think probably one of the most interesting questions, because it's that valuation that reflects the, what you might call the sort of aggregate sort of cost of capital to the industry. And of course, it's that cost of capital, it's that valuation that essentially acts as the transmission mechanism for price signals through to action in the real economy. The lower the valuation, the harder it is for that transmission mechanism to work, right? Because essentially, when you've got somebody that's on the kind of valuations that the mining industry is on, and it's not just the mining industry, it's any sort of it's the energy industry, it's the broad industrial sort of sector. All of those things that are actually necessary for human existence are derided and put on these sort of punitive and derisory multiples. All the sort of peripherals, all the frippery, all the irrelevance is put on these extraordinary multiples. And of course, this is the revealed preference of society at the moment, right? And that revealed preference says, look, we don't actually want to solve any of these big issues, right? We don't actually want to create a better world for our children. We don't actually want to create a better and more sustainable world for those parts of the world, that part of the population that doesn't already have access to the, to the standard of living that we take for granted. That's the transmission mechanism. And of course, how does that work in practice? Well, it's harder and harder and harder for companies to raise capital on those valuations. The incentive is always to buy back your own stock, right? Essentially, sort of buybacks become, the preferred mechanism, which increases the per share exposure of shareholders to what exists already today, but doesn't actually grow the aggregate output, at all, and creates this kind of break on investment activity. And it's often there's often a chicken and egg here in the sort of financial sort of services, I think, where people say, well, the multiple reflects the future growth expectations and the future growth options, right? And that is what's being, sort of embedded. And what we're sort of looking at is that the mining industry is going to grow at best at GDP, maybe GDP minus, and so on and so forth. But actually, it's the other way around. I mean, the multiple isn't the reflection of future growth. It's the enabler of future growth. It's no wonder that growth exists in certain of these sort of services. It exists by virtue of the fact that the cost of capital, the implied cost of capital, is so low. And therefore, these companies can invest in future supply. So again, it's this sort of chicken and egg of supply versus demand, and which you think sort of takes priority. So, you're looking at the sort of mining industry, you're looking at the multiples that we trade on, you're looking at the future sort of demand requirements for the, for, as you say, just broad electrification, right? Let's say in the case of copper, right? Raising just the aggregate sort of standard of living globally. Even before we start talking about decarbonisation, even before we start talking about the sort of Internet of Things, artificial intelligence, and the services that will sort of generate, even before we start talking about all of that, what we're essentially saying is that the capital markets are saying this is a non-problem, right? And yet when you do the analysis, when you actually sort of look at the long to medium to long run sort of analysis of what the actual requirement is, you say this is a profound impediment. There's a profound sort of, challenge that needs to be met. And, I often sort of think, I mean, if you were to sort of run this kind of thought experiment, or perhaps silly thought experiment, you were to sort of take, some sort of, little green man comes to visit the Earth and says the only sort of piece of information it's got is, access to the FT and, the sort of, the trading result, the capital markets. And you say, well, look, what conclusion would that visitor draw about the problems facing humanity based on the revealed preferences implied by the multiples these sectors trade on? And of course, that little green man would say, well, there is no issue with food security. There's no issue with energy security. There's no issue with raw material supply. All of these have all been solved, right? There is no future demand, that needs to be kind of incentivized, needs to be created. The world is awash with all it needs by way of housing and infrastructure and automobiles and capital. And everybody lives in a state of superabundance, material superabundance. And that the main challenge is entertainment for that superabundant and that, society. And that the main thing that we are lacking is entertainment services. That is therefore the thing that we must incentivize, the thing that we must create in order to, generate utility, generate wealth, or however one wants to say it. But you would not draw the conclusion that there is such a thing as sort of decarbonization and the challenge of sort of environmental change. You would not draw the conclusion that population growth in, parts of the emerging world where wealth, is so substantially sort of behind where it is in the, advanced economies. None of these are challenges. We have superseded, we have transcended all of those issues. And I find that paradoxical, to say the least. Every time I look at it, I go, what actually are we trying to say here? And again, this notion of the revealed versus the stated preference, I think, is so key. You ask any sort of set of investors, where are the challenges, where are the opportunities, and you just can't pick up a sort of government policy document without seeing. I was reading something from this morning, from the City AM about the sort of green transition and harnessing the city's ability for green financing, sort of deliver all of this, and the opportunities that are there available for us. Well, okay, but then let's see that, right? And it's in the actual valuations. Let's see that in the actual investment choices that are being made. And it's a bit like that. I don't know if it's apocryphal or not, that quote from sort of Warren Buffett, which is sort of, don't tell me what you think, just show me what's in your portfolio, right? So time and time again, you have that same kind of sort of question put to sort of investment managers, tell me what you think, and they'll X, Y, Z, and the other. Okay, well, what's in the portfolio? What stands behind that? What are the set of choices that you've actually made? And what you see is identical portfolios, only differentiated by whether or not Facebook is slightly overweight versus Apple, but no sort of aggregate positioning into those things that are actually capable of transforming society in the way that I think we all understand it needs to be, where the change needs to be made.
And do you think that's changing at all? I mean, we've recently seen Glencore say they're actually going to stick with their coal assets, that investors now back them to do that. Do you think we're seeing a change at all?
Yeah, world's least surprising announcement from Glencore there.
And we've seen, in the past, focus on ESG metrics in a way has hampered investors from getting involved in the mining sector. Do you think now, after we've seen this big backlash against being focused on ESG, that's going to change at all?
It's a really interesting dynamic, isn't it? I mean, and I think, if I sort of look back over the last sort of few years, I think there used to be the sort of sense that, ESG, I mean, I hate to use the term sort of greenwashing or virtue signaling or so on and so forth, but in a certain sense, that's kind of the sense you got, right? That, what was needed in a certain, was if we set these ambitions, we set these targets, and we set, these sort of make these statements, that this will somehow translate into, a lower cost of capital, a higher multiple, just by virtue of having made these statements and setting these ambitions. And that in and of itself, to that lower cost of capital, that higher multiple, would sort of create a sort of virtuous sort of cycle. Because, of course, then, those companies wherein there is that lower cost of capital are more able to afford investment. They will grow, preferentiate at a sort of faster rate, and so on and so forth. And it will create that virtuous cycle. But I think, what we've seen is the fact that, that's not really enough, right? Just sort of having those intentions and making those statements doesn't actually translate into a higher, a lower cost of capital, doesn't translate into superior returns, and investors are sort of, I think, probably quite rightly going, well, look, hang on, something doesn't quite add up there. And I think and I think that recognition that it's just not as simple as sort of putting out a glossy, sort of making, credentializing yourself in that space, that's not good enough, right? And I think we're now probably moving to a sort of healthier part of the debate where you've actually got to embed sustainability in the actual performance of your business. And that what you've got to make is a value case for the ESG, as it were, credentials that you are seeking to claim, so that you can't just sort of say, look, what we have is value on one axis and sort of, ESG performance on another, and that these in a certain sense can, are uninterrelated. But you've really got to sort of show what is the value case for ESG. Now, in the case of mining, I think, one of the great things about that is we've got both a supply and a demand aspect wherein we can make that case. On the demand side of the equation, it's so manifestly obvious to me that without the raw materials that we supply, not only are the sort of notions around sort of decarbonization, transformation of the global economy, all of that is kind of just so much verbiage, but the basic sort of principle of just ending global poverty, raising people up, from a standard of living that is frankly unacceptable in this day and age to one that is at least sort of commensurate with that which we enjoy. That basic sort of demand side solution is so profound for our industry versus so many others that one could name. But on the supply side as well, you've also got that sort of story, right? You look at some of the regions wherein we operate, right? I mean, who provides the infrastructure? The mining companies. Who pays the tax? The mining companies, right? Who creates the employment opportunities? The mining companies. Who creates the educational opportunities? Because when you are entrusting people with multi-million dollars of capital equipment, that comes with it. That comes with a certain sort of training. That comes with a certain sort of skill set, and that sort of base load sort of raises the entire sort of population. So you go to to Zambia, you go to the DRC, even in sort of Latin America, the importance of the mining industry as a force for good is so profound. And at the same time, when you think about what it is that a mining industry needs to be to unlock the resources of some of these countries, what is it that actually creates that license to grow, right? It's provide precisely that sustainability skill set. It's being able to go into a community, really listen to them, not sort of put your own or impose your own sort of views on it, but listen to what is it that you actually need? What are your concerns? What are your issues? How can we create a genuine win-win solution wherein we can provide what you need? We can sort of generate, and create that investment that creates so much, both local, but, the positive externalities of what the mining industry, does and to unlock those. And when you get that right, that's when you have the license to operate. That's when you can actually go into these countries and actually win the sort of, the competition and for the natural resources that these countries have. And I mean, at Anglo, we sort of pride ourselves on sort of Quellaveco, right? This was an example of something where we think, look, we did that well, right? This was precisely what enabled us to, to develop, to build, to bring that, to bring that mine, into production, on time, on budget, during, the whole sort of COVID sort of pandemic. And, of course, there's just, one to unpick exactly what happened there, would take us a lot longer than this. But that sort of sustainable model of economic development actually was perfectly aligned with the sort of private wealth creation. So the public and private benefit of the mining industry, was aligned. So in that ESG debate, we're sort of moving from that just sort of, the sort of pontificating aspect of it to the actual, how can we implement this in practice on the ground to create, win-win solutions, for, that create shareholder value, and broader stakeholder value, and unlock that enormous positive externality that comes with the mining industry.
So in terms of meeting that demand that we've talked about for clean energy, electrification, electric vehicle demand, how can mining companies meet that demand? Because if you look at it, actually, we've seen that most of the supply growth recently has come from Chinese companies, and 40% of the supply growth in copper over the last decades come from Africa. So why is it that the Chinese companies are investing more in new growth than the Western mining companies?
Well, that's a really interesting. Look, fascinating question again. I'm going to preface everything, but that's an interesting question, Henry. But we're touching on some of the really sort of profound issues, right? I would say that sort of there is a, you see what you see in China. I was struck. There was a recent interview by the executive chairman of Barrick, Mr. Thornton, and he was asked exactly that question, and I'm trying to remember exactly his words, right? But I think what he's put it down to is, how did he describe it? They're hungrier, more tolerant of failure, and quicker, right? And when I sort of think about it, it comes down to this sort of sense, again, this sort of cost of capital point, the aggregate desire to take on risk and to search out for opportunities for investment. Now, in the West, mining, actually just industrial activity, actually productive capacity, right, is regarded with opprobrium, right? We don't like industry. We don't like manufacturing. We don't like investment. What we want is consumption of entertainment services. And there is a whole host of negative perceptions that encumber the mining industry and encumber the broader sort of industrial space. Now, in China, I don't think they have that. They regard industrial activity, they regard the primary extractive industries, they regard these as the very sort of proximate lever that has created and moved the single largest, number of people in the shortest time that we have ever seen out of poverty anywhere. So what they see in the mining industry is a whole host of positive associations, and there's these positive externalities that I was talking about. The copper that you create then sort of feeds into, of course, the downstream into the manufacturing industry that adds value, and then from the manufacturing industry down into the sort of capital stock, and you see it, right? Just a generation ago, you didn't have schools, hospitals, roads, access to power, utilities, and so on and so forth. And in just the space of a generation, you do. And all of that has been predicated on the manufacturing might that China created. And of course, you look at the previous periods in the history of the US, previous periods in the history of the UK, and you see exactly that same sort of, that same attitude, right? Everybody understood just where and how wealth is actually created. Not the redistribution of wealth, but the creation of wealth. And of course, that then sits with the Chinese industry. That's their sort of underlying sort of philosophical sort of structure that stands behind their activities. That's their self-understanding, right? And of course, that then creates the dynamic, right, where they have a lower cost of capital. Well, what do we really mean by that? We mean they have an aggregate desire to take on risk, right? An aggregate desire to invest. And that is supported, right, by their shareholders, their stakeholders, and is well understood by all sort of aspects within both the broader, society in which they operate and within the sort of company itself. And I think we've lost that in the Western world. I think we've lost that by and large in the, industrial economy of the West, right? The animal spirits that used to animate the industry, right, are in short supply. And you can sort of pick, and identify certain individuals, right, wherein those animal spirits are still there, right? I mean, a classic, not that one wishes to eulogize Robert Friedland here unnecessarily, right? But, you look at an individual like that, right, that has gone into, DRC, that has been there for an extended period of time, that has put risk capital at work, right, and then has created something like Ivanhoe Mining. And that's the kind of dynamism, that's the kind of animus, right? That's the sort of genius that used to be so common, I think, in our industry. Again, you look back at the sort of great figures in, for example, the history of Anglo American, the Oppenheimers that created the Anglo American that we have inherited today. And you see that same energy, that same spirit animating the company. That's what we need to recover.
And obviously, you either acquire copper companies or you build your own mines. I mean, given BHP's recent, failure to take over Anglo American, your own company, do you think the impact of that is going to be that companies now focus on investing in their own mines, building their own projects?
Yeah, the stalwart defense of Anglo. Look, it's exactly that. I mean, the revealed preference of of BHP is very clear, right? And for very understandable reasons, right? I mean, you saw that in sort of Oz Minerals, as a sort of precursor. Then you've seen it again in the attempt at Anglo American, and you've seen it more again more recently with Philo, right? Albeit what they're purchasing there is the option to to invest in in building sort of capacity more than it was in the previous two examples. Look, it's a really sort of interesting debate. And again, it sort of gets back to that sort of cost of capital. And it's also the price of copper, right? The risk discounted expectation in, for future versus the capital intensity and the time it takes to create new supply. At the moment, right, when valuations, even in the copper space, where valuations are high relative to the rest of the mining industry, they're not high in absolute terms, right? They're not high when compared to other sort of sectors, right? If you look at the price of copper versus the cost structure of the industry, you're left with a sort of sense, well, we can see what's hoving into view, right? We can see what the medium to longer term, but that's not yet reflected in either our valuations nor the price of the commodity itself, which makes it very hard to then sort of approve the build decision, right? So you could approve the build decision, but what you're basically embedding is a sense of economic assumptions that are not yet in the spot market, as it were. So until we sort of see that change, this sort of tension is always going to be, well, it's better to sort of, frankly, buy rather than build, right? And what we need to see is the cost of capital fall. We need to see the copper price rise. And it's that dynamic that then sort of changes the equation from buy to build. And it's that dynamic that actually then creates the future supply that the industry and indeed the globe, the world economy needs, right? Because of course the problem is, as we all know, right, with the buy decision, right, what are you doing? You're not actually sort of increasing the aggregate capacity, you're just shuffling the paper claims on pre-existing assets. And then there's a sort of second order effect where you go by reordering those claims, it's hoped that then there will be more productive capacity that will be invested in as a consequence of that. But that's a pretty big leap that you have to make, right? That simply by restructuring the equity ownership of assets, right, that you can then lead to better real world solutions. And the whole sort of, Mogliano and Miller kind of instinct in me sort of, looks at that, with, well, rather I suck my teeth when people sort of start making those claims. Not of course that there isn't some truth or some, rationale for it, but, you have to work pretty hard, right, to think that that sort of redistribution in and of itself is a powerful enough factor versus the more sort of obvious sort of point, which is the world needs to wake up and properly price these assets.
And talking about the copper price, we've seen copper prices come down from their record high of $11,000 a ton to $9,000 a ton. And there's obviously lots of concern at the moment about China's slowing growth. They're the largest copper consumer, obviously. So how do you see the market panning out?
Well, look, I mean, I think it's sort of reminds me about that sort of joke about the economists. I mean, what's the definition of an economist, right? Someone who's predicted 7 out of the last 2 recessions, right? I mean, there's always that, sort of risk aversion that we need to, sort of counterbalance in the short term with a sort of longer term understanding of the sort of trend line. So, I mean, I think it's fairly obvious what's happening. We can all see it in sort of the Chinese construction industry, right? We can all see it in sort of sluggish sort of Eurozone sort of, inertia. We can sort of look out and, in the UK, and we can sort of all sort of see what's going, the sort of current sort of situation. And of course, all of that, is fairly, fairly sort of disappointing, right? You can look at, for example, at electric vehicles and the slowdown in the adoption rate, thereof, right? Which, of course, speaking purely from an Anglo perspective, is one of the reasons of the platinum hedge in the portfolio, right? So, we get it on one hand and we, lose it on, on the other. But, we can all sort of see that, sort of writ large. But I think the thing we've got to sort of bear in mind is that this is a long-term industry, right? And the cycle is always going to be there. The sort of volatility of stocking and destocking cycles, right? The volatility of policy choices made in various governments, by various governments, across the, across the globe, is always going to be there. But then when you sort of overlay that on the sort of longer term trajectory, right? There are certain things I think that are sort of fairly incontrovertible, right? I mean, you look back and even the sort of Great Depression looks like a blip on an otherwise sort of solid trend line, like 2008. Again, a similar story, and sort of time and time again. When you are in the midst of these crises, no one really knows what the mechanism is that's going to take you out of that crisis. If they did, right, then those policy choices would have already been implemented and we would, kind of not almost by definition be where we are. So, you can read, and one of the things I enjoy reading is, the annual reports of mining companies back from sort of 1900 to sort of date, right? Big sort of, and you can read, what they sound like at each of the bottom of each one of these sort of crises, and it sounds identical, right? The fear, the uncertainty, the lack of sort of, clarity on how this is going to end and when it's going to end, and the all too human desire to put a date and a precise time, tell me exactly the mechanism and the exact time by which we are going to be able to sort of, move out of the current funk, right? That's always been impossible and it remains impossible. But at the same time, we know what the sort of trend line sort of looks like. So, in our industry, we, it's capital intensive, right? It's long lead time. The commodity price is, highly volatile, and we are exposed, really like nothing else, to the macro sort of cyclicality, of the sort of global sort of economy. And we have to navigate all of that as best we can. And I think the thing that you have to do is sort of just anchor yourself in that sort of longer term understanding, right? The bad times are never as bad as you think they are. But of course, the flip side of that is neither are the good times, right? And, at the bottom of the cycle, it's, we have to avoid despair. At the top of the cycle, we need to avoid the sort of excessive euphoria that we've seen, in previous cycles. And it was that excessive euphoria, in let us say that the real sort of boom years of sort of 2006, 2008, and again, sort of 2000 and let's say, 10, 11, 12, that did so much to sort of discredit the mining industry as well. And in many senses, part of the sort of, the cost of capital issue that we were discussing previously is, of course, part of the industry's kind of own fault, right? I mean, there are a number of sort of own goals there that we need to sort of, we need to avoid. We need, as an industry, we need to get better at understanding and articulating cyclicality, understanding and articulating sort of the longer term nature of the industry, and acting, accordingly, right? Sort of mistimed buybacks right at the top of the cycle are never a good signal to the sort of city that you understand either, your own valuation or your own industry. And so, of course, to be, to be avoided. But at the same time, right, executing those at the bottom of the cycle, sends exactly the other signal.
And how certain are you about the demand from decarbonisation? I mean, we've seen sales of electric vehicles globally slowing down. I mean, they're still doing pretty well in China. China's kind of propping up the global market, but we have a US election coming up. I mean, obviously in the medium term, longer term, we need to decarbonize, but how certain are you about the short term demand?
We've got to get there. Yeah, we've got to bridge that gap. I mean, look, over the sort of longer term, I think sort of very, very solid, right? I mean, decarbonisation is clearly, one of the sort of challenges of the generation, right? It is a secular issue that we need to respond to. But at the same time, I mean, when you look at the reasons why people aren't buying EVs, right? Some of the sort of concerns people have, and the response by policymakers to those concerns, it's kind of misguided. Sort of telling people that range anxiety isn't a thing, and that they needn't worry about it, and that mobility as service will solve all of their problems. That's just basically turning around and saying, look, that's just sort of fingers in the ears, right? It's not true. Range anxiety is real. Mobility as service, it's in the provision of everything that I need it to do, doesn't really work for a lot of people. But there are significant concerns around, if you are in multi sort of housing accommodation, how does charging work? Right? How can I use these vehicles in the same way that I've, experienced my experience with ICEs and so on and so forth? These are real issues, right? And what you're sort of seeing is sort of policy making on EVs that is running ahead of policy making on infrastructure. And then, of course, where that sort of creates a sort of dissonance, right? These kind of sort of issues, are to be expected. So I think that there is, something there, around making the coordination, of all of these, policy sort of initiatives to ensure that things like sort of electric vehicles and so on and so forth, can have the impact that they will. There's also this sort of issue around sort of tariffs, global trade, what we, and our relationship with China, right? I mean, China is capable of producing very high quality, very low cost electric vehicles and exporting them to the rest of the world. Now, one narrative is that China is just cheating somehow, miraculously. Don't like that. The reality is, of course, that China is capable of producing these goods at a lower price in the same way that they're capable of producing any other good at a lower price point, whether or not it's a washing machine, an air conditioner, or a handset for a smartphone or an electric vehicle, because they have an integrated industrial capacity that enables them to, synergize and create and capture the economies, of scale and of integration. They have a coordinated industrial policy that recognizes the importance and the hierarchy of goods in that economy, from the production of raw materials through to their processing and then through into their sort of manufacturing capacity. And you ally that, of course, with labor that is, well, I mean, I'm not saying that the labor is sort of, I mean, the labor rate is what it is, but it's, that it's the aggregate integrated nature of their industrial capacity that enables them to do this. Now, we've chosen, again in the West, to unwind that industrial capacity, export it to China, right? But now refuse to import the goods that we knew that capacity was designed to create. I mean, that's somewhat, there's a tension there that doesn't really sort of hang together terribly well. We decided to deindustrialize, move our industrial capacity, concentrate our industrial capacity, in China in a sort of grand sort of Ricardian experimenting comparative advantage. But then after having done that, now complain that the goods that they wish to import, export to us are cheaper than what we can, than that which we can manufacture ourselves. Well, kind of obviously that was the whole reason we did it, right? so the flip side of that is not then to sort of, or the correct response is not now then sort of complain that that is the status quo, but then to sort of revise, well, did we want and did we understand the full implications of deindustrialization, of hollowing out our manufacturing capacity, right, and of the transition, right, to a consumer, and a service sort of based economy. Now, if we wish to reverse that, then that has a whole host of implications. But it's that will then sort of enable us to produce these goods ourselves without the sort of reliance on China, and accelerate their adoption, and then sort of fix these, the negative externalities, things like sort of carbon pollution more generally, and so on and so forth, that we wish to see, avoided. So, I think that the long run challenge is that, I mean, I don't see how we can sort of face some of these sort of energy sort of projections, temperature projections, and not sort of see the cost of those, and the investment that is going to create value in the avoidance of that, right? So either we must invest to eliminate the cause, or to ameliorate the impact of global warming. But of course, this again, it gets back to the sort of problem of our revealed versus our stated preferences, right? This is a challenge. It is long term. It will require sort of blood, sweat, and tears. And the question is, are we actually prepared, to make that sacrifice, or not?
And I mean, putting it the other way, if you're a company that uses copper to build electricity grids or for your electric vehicle batteries, you may want to diversify, right? Hedge your exposure, not put all your eggs into the basket of the copper mining industry. How much do you think that's going to happen? They're going to use other materials such as aluminium, or reduce the amount of copper they use in electric vehicle batteries?
Yeah, look, I think that's ongoing. It's always always been an issue in the in the commodity industry. I mean, there's always sort of both thrifting, just reducing the absolute amount of the material, and substitution, into metallic sort of substitution, and both of those effects are clearly very real. And I think, from the mining industry perspective, this is something that we have to, be very sort of cognizant of, right? It's all very well we sort of sit here and say, look, there are issues, there are structural issues with it. We have to sort of work sort of harder. But of course, as you say, from then a consumer perspective, we have to sort of, create the confidence that kind of we got this, right? That we do know this is something that we as an industry have been, facing for a very long time. We understand what it will be, what's required, to deliver, the supply of this. And, yes, right, it may not be that we are now in a world of sort of cheap and abundant sort of copper, but it's not a world in which there's sort of a Malthusian constraint and we're all about sort of run out of this stuff by a week on Tuesday, right? That again, that's sort of, the despair and the euphoria kind of point that I was sort of, talking about. So, it's clearly the case that there are challenges. It's clearly the case, that, when we look at sort of Western capital markets, are they really fulfilling the function for which they were, designed, right? Namely, the provision of capital to productive, genuinely productive, industry. At the same time, the age-old sort of story and the narrative around sort of geological deterioration, grade decline, and that broader sort of sense of, whether or not it's grade or stripping ratio or mine depth, location of assets and so on and so forth, it all sort of combines to that sort of, just that sort of geological, the geology is just sort of getting, harder. So all of these things are well answered and well sort of well-worn sort of narratives. But at the same time, as you say, it's vitally important that we as an industry, the mining industry, can actually supply, these goods. Because without that, essentially, a lot of the time thrifting and substitution implies that you are making inferior choices in the design of the goods. And that ultimately is a sort of, counterproductive. Now, of course, not say categorically all the time. Some of the time there's genuine and sort of innovation, but that's the risk you run.
And could you see, for instance, we've seen in lithium and nickel, direct deals between consumers and mining companies, such as General Motors investing in the Thacker Pass lithium project in Nevada. I guess one way to secure copper would be to do these kind of deals. Are we going to see this in the copper industry?
Look, I think that's a really good point. I mean, exactly that, right? I mean, if we look at the sort of oil industry, right? I mean, the syndication that takes place in the sort of large capital intensive projects, it's probably where we're heading, right? Now that syndication, whether or not that involves, it's sort of horizontal or sort of vertical in the sort of supply chain, other mining companies or consumers and, along the value chain, sort of all participating and sharing the risk and of course the sort of capital burden in sort of developing some of these sources of supply. I think that's exactly, that's exactly the direction of travel. And when I was sort of talking about the integrated sort of nature of Chinese industrial sort of capacity, I think that's kind of one of the things that you see, that characterizes, that, right? I mean, whether or not it's sort of, sort of formal or sort of semi-formal in its nature, there is definitely that sort of risk sharing and that coordination through the supply chain. Right. I mean, in the nickel industry, sort of a case in sort of point, right? In terms of how that has evolved and how that then sort of feeds into the, the EV industry, within sort of China. So I think that's exactly right. That will be a development, I'm sure, that will help, reduce the risk, reduce the sort of weight, the individual sort of capital burden, to any one of these companies. And, if we can sort of just move to a sort of, a mechanism where we are sort of happier with the, relinquishing some of that control in favor of sort of joint operation, sort of joint operations, or indeed, sort of minority sort of positions in some of these assets. So there are examples of that. I mean, you sort of look at sort of, Koyawasi in our own portfolio is very successful, joint venture that we run. They're one of the best copper mines, on the planet. You could look at, say, Antamina again as another example where that exists, in the industry, multiple sort of, participants, in that. And of course, Escondido, right? I mean, Rio and BHP have been running that thing, for a very long time.
And Paul, I just want to touch before we end on productivity, because one of the interesting things you've highlighted is the amazing increase in productivity in the mining industry in the 20th century that's enabled all of the economic growth that we've so taken for granted. And you give an interesting statistic that it took about 40 years of man hours to produce 1 ton of copper in the Roman Empire. Now that's come down to about 21 days. But you say this has stagnated since around 2003. Do you think that's going to continue to be the case? Or are we going to see new technologies, new processes that could boost the productivity in the mining sector going forward?
Yeah, look, I mean, I think that's exactly right. I mean, obviously, when one's going back to the Roman Empire, working out the purchasing power of, of a sestertius versus, something else is always a little tricky. But, thankfully, the edicts of Diocletian do enable one to get some handle on that. So, very interesting stuff there. But you're absolutely right. I mean, I think what we miss, right, what we fundamentally miss, what is the reason why we are wealthy today? What is the reason for the material prosperity, right, of modernity? Well, it's the material prosperity is a direct function of the material productivity of the primary extractive industries. The reason why copper is cheap, right, in an absolute sense, is because of that sort of transition, the incredible gains in productivity that have characterized the mining industry basically since the since the start of the Industrial Revolution, right? But you see that in again, it's not just mining; it's the primary extractive industries. All other productivity is essentially parasitic on the productivity of those primary extractive industries. And were it not for the fact that agriculture has increased its yields in the way that it has, were it not for the fact that the energy return on investment in the energy sector has been so significant, right? Were it not for the fact that we in the mining industry have done likewise in terms of increasing the ability and the amount of work that goes into the extraction of raw materials, all other productivity that we see in the economy would disappear, right? That's the basic sort of modality that stands behind our wealth, today. And if you look at, the last, really sort of transformational shift in the mining industry, it took place over the sort of 1970s to the early sort of 2000s, which was, in the case of, for example, in the case of copper, it was 2 things. It was introduction of sort of hydrometallurgical techniques, so-called SXEW revolution, and just the increase in scale, the ultra class of mining equipment that was brought to bear, right, over that period. Haul trucks went from 40 to 400 tons. Actually, they went more than that. There was a 10-fold, 20-fold increase in the scale of mining equipment and a corresponding reduction in the sort of labor and the factor inputs that fed into it, which of course is just represents itself as an extraordinary increase in productivity, over that kind of period. Now, the issue is, when it comes to sort of the early 2000s, a lot of these productive, factors have essentially started to slow, or indeed, in certain cases, reverse, right? And you've always got in the mining industry these sort of two, sort of at the highest level, these two competing forces: technological innovation, which is deflationary, and geological deterioration, which is inflationary. And of course, there's the sort of, the whole sort of Club of Rome, the limits to growth, kind of, dynamic was taking one side of that and sort of a very sort of neo-Malthusian sort of interpretation, and sort of implied that therefore there are these sort of strict limits to growth based on this. Another sort of, angle on that is to say, well, actually, taking over the longer term, human ingenuity has always overcome those, those obstacles. Now, kind of, so where do we sit today, right? Well, I think the risk is that because the broad society doesn't understand what real productivity is, that we tend not to allocate resources in the right way. We underestimate the productivity gains that have taken place historically and where those productivity gains have really originated from. And therefore, we tend to misapply what productivity is, and we start talking about productivity in digital services. That's not real productivity, right? That's, sort of, I don't know what it is, but it genuinely doesn't raise the standard of living of anybody anywhere by any appreciable degree, right? So the problem I have is that, when we look at, sort of, where the great, I mean, again, this is a sort of, it gets back to a sort of cost of capital point, right? Where are the allocation of resources going? And this is, again, my little green man experiment, right? Again, when they come down and they say, well, where are they really, where's the smart, where's the mind power sort of going here, right? And again, it's the creation of digital entertainment services, and it's the creation of, platforms for the distribution of pornography and amusing cat videos. It's the sort of creation of sort of mindless sort of apps that simply destroy, our ability to sort of, engage with ourselves in isolation. Sort of, if we're not occupied by pressing buttons on an iPhone, we sort of somehow feel that we're kind of missing out on something. This is where the minds are being sort of diverted, right? It wasn't always the case. So the question is, are we allocating, the human resources, in the right way, so as to unlock what the, where the sort of next big shift in sort of, productivity will come from? Is this sort of, further hydrometallurgical sort of techniques? I mean, we're all looking at sort of different sort of leaching options in the copper industry. Will this take place from sort of, automation, right? Will this take place, in, for example, advanced underground mining technologies that hitherto we sort of don't really sort of, understand? How will, where will that sort of next shift take place? Now, in the sort of short to medium term, to be frank, I'm fairly sort of pessimistic, right? Simply by virtue of what we are seeing sort of, in the data. And it reminds me of that sort of Solo quip, right? You can see the computer age everywhere except the productivity statistics, right? And there's a sort of big danger, in that when we sort of misunderstand productivity, we think that sort of productivity is, is sort of equivalent to sort of being able to add more pages to an annual report, via, using generative AI, right? I mean, cui bono, right? What's the gain in that, right? But over the longer term, I'm something of an optimist, because eventually we'll figure this out, right? We have to, because what's the alternative, right? And there will be a reorientation in priorities, and human ingenuity has always sort of proven itself capable of meeting that task, and I think will be the case going forward as well.
Great. Well, thank you so much, Paul, for joining me today. It's been a fascinating discussion. Thanks so much for your time.
Absolute pleasure. Keep well, Henry.